Case study number 6 continues from case study number 5. Let's take a look at the same Canadian dollar daily and see what happens near the highs. Here is that CD leg going up to the highs that we said we should be shorting. This move shows tremendous bullish energy, thrusting strongly up into multiple Fibonacci numbers. In this case, we had 4. It may need to bounce sideways to shake off the bullish energy before dropping. But in this sideways shake, there may be some interesting trade setups as well. Let's take a closer look. First, there's this time range that is wider than previous time ranges. So it seems to be somewhat dominant up here. So this can be our dominant ABCD move. Now let's take a look. Here the BC is shallow. Let's take a quick check. It's right at 38%. The CD leg is smaller than the AB. Now let's take a look at the low of A. The low of A is somewhat lower than previous pivot lows. Those 3 items are the first 3 rules of measure move strategy number 1. Let's see if we can make it an improved measure move strategy number 1. And what that is simply is we look at how price action falls from capital D to give you a buying opportunity, and of course to apply the 2 Fibonacci retracement numbers. So right here, as you have a bar to bar, lower high, lower low, making that point D a real pivot high, then that's where you would be asking this question. Because right there you already have the dominant measure move and all the setups that would qualify this to be a potential measure move strategy number 1. So let's put on Fibonacci retracement. Let's do 38% of that and 78% of C to D. So there's measure move strategy number 1 with Fibonacci ratios. Now this is the buy area. What makes this an improved measure move strategy is to see how price action unfolds into that area. Let me stretch it out a little bit. Here you also see a little ABCD unfolding into this pre-calculated area. Now let's check the retracement of little c. We're going to go from A down to B. Little c is just shy of the 78% retracement area. Still pretty deep. So now let's apply measure move extensions to this little structure. Click at A, drag it down to B, up to little c. Now here's the 127 measure move extension in blue. The other 2 calculations off of the larger green formation is grayed out. You can see how this bar here is a huge bar, and we may or may not want to jump in and get in front of that. Now here's the 161% measure move extension coming off of a very deep retracing point C. That is very, very oversold in terms of measure move extensions. So if you were to average this number 161 with the other 2 pre-calculated ratios, you would have a very good set of 3 Fibonacci numbers in which to average and buy. And once you buy there, it moves up from there. Now why did this move not exceed A? Even though there's this huge bar here backed up by another one end to end. Well, remember what the monthly chart was telling us back in case study number 5? Monthly chart shows resistance. So these are the highs that we said we should be shorting. So even though this thing worked out nicely with an excellent buying opportunity right about here, make sure you take profits no more than the 78% retracement level of little a to little d. That is this level right here. So you can still buy around 8,900 and get out about 9,100. That is still a $2,000 move in a couple of days. And of course, your stop loss should be one tick below here to protect your buy over there. Oh, and finally, you can also check time ranges. Now here's a legitimate time range. Now this one's not really a time range because it is just an inside bar sandwich in between, but it looks like a semi-time range. In any case, once you have an inside bar or an outside bar, that's like a little speed bump. And you want that speed bump to be shown, especially when you're coming off so strong off of little point C. So that is a good sign. This is sort of showing time ranges getting narrower. So this also shows that price action around here is really slowing down from dropping off of C and is preparing to really move to the upside. Just to recap, the weekly chart and the monthly chart back in case study number 5 tell us to get out of our longs somewhere around the 9,100 area. But in spite of that, you can still find buying opportunities to go long and make a couple of $1,000 even at these high levels when the setups warrant it. The only thing is to not overstay your welcome. So you can see how different time interval charts can collaborate with each other to give you excellent superstructure trading setups. Case study number 7, September T-bonds, 16 minutes. Let's say you're right there looking at that bar. So right here, what you're paying close attention to is the breaking of pivot highs or lows. In other words, it can either break below this pivot low or above this pivot high. Let's say it breaks above this pivot high. So the next bar goes like this, and the following bar goes like that. Now right here, if this was to happen, you'll be looking at several things. You'll be asking yourself, how deep is that retracement against this move? Is it deep? And also, how deep is this retracement against this move? Because now this would be A, confirmation of a B, C. You're coming off of a C, and you're breaking right here above this high to confirm this ABCD measured move price structure. And then you'll be comparing sideways time ranges. How wide is that versus that? How wide is that time range versus that? Those are the things that you'll be asking. Second scenario would be when price action breaks below this pivot low here. Again, it's meaningful only when price breaks above or below a pivot. Let's see what you need to do if that was to happen. Here's a situation where it breaks below and forms this measured move, A, B, C, D. Here it confirms the making of this measured move by dropping below this pivot low here. So here you'll be also asking what the comparison would be, time range here. And you can see that the very next bar would give you a wider time range comparing sideways, which means it may have quite a ways to go down before bouncing back up. And if this bar or the next bar was to break below that low there, here it breaks below this low here. Now this measure move comes into focus. From here you have A down to B up to C and on its way down to D, confirming this measured move. And of course this would be the dominant measure move, and that little one will be a measure move within a measure move. Here you can also do time range comparisons. How wide is this compared to that? It is narrower the second time around. You also need to look at retracements. how deep is this retracement against this drop, and how deep is this retracement here, the BC, against this move here, the AB. Here you can see the making of this little measured move as this bar breaks below this pivot low. And you can see the retracement at little c is between 61 and 78%. And we'll call that retracement medium deep. Now here's the next bar. It breaks below this low here. So now, as mentioned earlier, we have to address this ABCD formation. And here I've drawn in the capital ABCD. Now, we haven't reached point D yet, but what we see is that little ABCD is, of course, a measured move within the bigger measured move. And capital ABCD in green is the dominant measured move. Now let's check to see how deep this retracement is, capital BC, off of the AB retracement. Here capital C, which is also little a, shows up as a medium deep retracement, also between 61 and 78%. Now we can also take a quick peek at time ranges. This time range, comparing sideways, is narrower than this, which means it may go down quite a bit before going up. And now if you're to compare T1 over here to T2 over here, it gets narrower. So this gives you a vote of confidence to buy down here to go up. So the move within the move here shows a widening time range, but the bigger dominant measure move shows a narrower time range. So we'll go by the bigger one, but we're also going to keep an eye out on the smaller one. Okay, so now let's apply measure move extensions. First, we'll apply it to the dominant measure move. Here you see the 100% and the 127% off of the dominant structure. And here you see the 127% and the 161% measure move extensions off of this little ABCD. So here, focusing in on the 100% dominant measure move extension, the 127 is supporting it somewhat. The question is, do we want to think about buying over there? Well, remember, we have medium deep retracements over there and over there. Not quite 78%. And then there's this huge bar going down, breaking through over here. So with that showing up, we need to perhaps focus in on these numbers here, which is the 127% measure move extension off of capital ABCD, the dominant measure move, supported by an extreme 1.618 measure move extension off of this supporting structure. On top of that, we should take a look at this range right here. This little range, we can also think about extending down 2.618 to give us maybe another calculation. This is more conservative. We're looking for that third Fibonacci extension number, preferably something extreme. And that's what we're going to look for to average in with these two numbers to be conservative. And that extreme single-sided extension comes in right around there. Here we can average these three Fibonacci numbers to get a very, very conservative buy. You have the 127 off of the dominant measure move. That's somewhat stretched out, supported by a smaller measure move within the measure move, showing the 161% measure move extension. And I also threw in the 261% single-sided extension. So here is where extreme calculations fall, and there are three of them. Again, coming off of retracements that are not super deep, we need to do that. Here is what happens afterwards. We have a fantastic rally going up to here. By the way, Q-Charts uses these decimals after the numbers, whereas the bonds actually trades in 30 seconds. So keep that in mind. Let's take a look back to see where this formation is in the larger scheme of things. This is a very good buy because the thrust going up to A is a very strong one, which is very, very bullish. And there's simply a shallow retracement on its way up to A, which makes this, again, a very, very good area to buy once price action unfolds down below little b and capital B. Now let's take a closer look again right at the point of impact. Remember, we're looking at this 60-minute chart of T-bonds. Each bar is 1 hour. So this can be a day trade type of scenario. In other words, if you were to trade something like this, it would be somewhat necessary to watch intraday price action. Just keep in mind that all these principles work in all time intervals. I'm just showing you different time interval charts to illustrate how effective they are in all intervals. You can trade the monthly chart, weekly chart, as well as intraday charts. Here I put in the grids to show the different days. Here you see the last hour of trading right before the close. It closes strong thrust up. Next, you want to look at this time range and compare to this one. Now they're equal if the next bar at the open breaks below these lows right away. These lows are exactly at the same low tick, as you can see. So you can count 1, 2, 3, 4 bars if the next bar opens and trades below these 3 lows. This is already established as 4 bars wide. So it would be a tie in terms of time range comparison in a series. But here is the first application of gaps, because if we close strong up and we open somewhere down here, that means we are poised to go up because of the gap theory addressing the previous day's close, the last thrust into the close. And again, here's what happens. It opens gap down, trades a little lower into those 3 pre-calculated Fibonacci numbers, and then rallies. So here in this example, everything is addressed. Retracements, time ranges, measure move within the measure move, the gap theory, and the overall direction of the market. Here, price and time align beautifully to give you your superstructure buy, a very, very predictable part of the market to trade up from here. Case study number 8, the July cotton daily chart. Suppose you come home from work, update your charts, and see this cotton chart. As you look at that last bar, you see that it has exactly the same low as this pivot low. Looking back further, you also see that you do have a series of lower pivot highs and a series of lower pivot lows. Here you see outside bars, inside bars, and a bunch of sideways formations stacked on top of each other. Now, here you might think about going short as a breakout trade to the downside. Why? Because you see these 2 bars here. They are end to end, and they are knocking on the door, which means the next bar may break below this pivot low. And the question is, would you want to trade this breakout to the downside? Whenever you trade breakouts, you must compare time ranges. Now let's do sideways comparison first. Now, this is the pivot low that will be used for this comparison. And you notice that this low here is actually lower than this bar's low. So T1 would be going backwards 1, 2, 3, 4 bars, And if price action was to break through below that pivot low, you would have 1, 2, 3, 4 bars as well. Here it would be a tie. So if the next bar was to show up like this will be a tie sideways. But now we have to compare time ranges in a series. If this bar was to break below this pivot low here. So here is T1 and here is T2. And here T2 is wider when comparing time ranges in a series. Now let's take a look at the next bar and see what actually happens. Now keep in mind that these two bars are pretty much end to end. They are long bars and they seem to be saying to you, hey, we want to go down in a hurry. With this bar closing at the low tick. And it's always a good idea to compare the speed of the ranges. Meaning here is a pretty strong range. The bars are end to end. The bars have very little overlap. This range here, of course, is a move against the trend, and you have more overlapping bars. Now this range here, from this high to this low, you also have a lot of overlap in those three bars. Also overlap in bars going against the trend here when you look at that range. But again, this is different. Now you can sense that there's a lot of energy, a lot of thrust in the making to the downside. So if and when the next bar was to break below this, a breakout might be a good trade. Because you have neutral time range comparison here, sideways, and time range getting wider here. Of course, wider time ranges tell you that the trend should continue down further. So let's take a look at that next bar. Now it actually forms a double top. And there's the pivot low in the middle, in which this bar confirms. So we'll use the rules of the double top to see where we may think about exiting this short trade. So somewhere in here we need to take profits, but where? So here you see the extreme extension off of a double top, right around here, the 261%. That would be an excellent place to say, look, I'm going to just take profits right there. Now let's see how price action actually unfolds as it works its way down. Here it reaches that extreme double top calculation right here with a long bar. Now remember, we went short about there and we're holding a short position. And the thinking is a little bit different than trying to go long somewhere down here. Down here, we need to be conservative and take profits. So now let's see what happens. Well, it's a good thing we covered and got out of our short position. But now, let me ask you this. Would you buy here to go long? Well, again, after a long, huge bar, I would probably not. But to summarize, we can go short here because we are comparing time ranges and they align properly both sideways and in a series. So here you have a superstructure short breakout setup. Right here and on this bar you can go short and write it down to this bar's low right here and get out right there. Okay, let's move on and see what happens further. Now again, we're no longer short over here and we'll just let the market do what it wants to do here. Let's take a snapshot of the market right here. And what you see are two bars here end to end with this huge one breaking below this pivot low. It breaks through off of a higher pivot high. Now it's moving towards this pivot low here, which means in a preliminary sense, when we compare this time range here with this one here, it's going to be a lot wider. And we know that it was already getting wider even before this scenario here. So let's see what the next few bars bring. Right here we can see that this low is not lower than this low, and so far this high here seems to be some sort of shallow retracement against this move. Now again, it hasn't broken through yet, but it's threatening to do so at this moment in time. Now we can compare sideways time ranges. Now we already have this one established. It's 2 bars wide. The fact that this hasn't broken through yet, the next one would be at least 3 bars wide. So let's see what happens. Here the next bar shows up and this low comes in lower than that low by a little bit. Now if you had placed an order to sell short on a breakout below that pivot low, you would have been filled. Your buy stop to protect this short position would be 1 tick above this high here. And of course you're looking to go down here. Now the idea to go short here is because this time range here sideways is wider than this one by 1 bar. And you're anticipating the breaking of this pivot low here, which very well may happen since we're coming down bar to bar off of this pivot high here. And again, you're looking at a very, very wide time range when that happens. But you can also see this as a trend line break. Here's capital B, here is little b, and this can be point X. So here's that trend line right here. And here we've broken through, technically speaking. This low here has gone below X by about 2 ticks. Again, so long as the sideways time range comparison to the left and to the right of X shows wider, we can expect this to be a good trade, especially when coupled with this retracement here that is somewhat shallow. It's right at 38%. So let's see what the next few bars bring. And there's good follow through to the downside, as you can see. How should you take profits? We should look at this little range right here and do a 2.618 single-sided extension down, and that's a good place to take conservative profits. So it would be a safe place to get out here. But if you're very aggressive, you can trail it bar to bar and ride it out for more, but I would not. Now let's see what the following bars look like as the market trades forward. It actually goes down much further. So here you have another superstructure short breakout setup, getting in right about there and covering your short right about there. Now keep in mind that breakout trades rely heavily on the alignment of time ranges, whether it's here and here, or here and here. Actually, we want both of those alignments to be in proper order. In this case, we do have that, meaning they're getting wider at the point of breakout, which is where we got in short. Excellent breakout setups. Case study number 9, the June Dow Jones daily chart. Let's take a look at this very last bar here. First, it has moved above this high, higher high, and it comes off of a higher low. This higher low is also a very deep retracement, about 78%. You can simply estimate by eyeballing it. And then you see this drop that it is moving up against. It is somewhat of a strong drop, just one shallow little retracement along the way. With that in mind, we're not going to go long, but we're also not going to go short yet because we don't have any other clues aside from the deep retracement. So now let's just watch to see what happens with the next bar. The next bar is a lower high, lower low, bar to bar formation. And it breaks below this pivot low here off of a higher pivot high. At this moment in time, we can do sideways time range comparison. Here's T1 and here's T2. Now you can see the second time range here at T2 is actually narrower than T1. 3 versus 4. Okay, let's review. Number 1, we came off of a higher high. Number 2, sideways comparison shows a narrower T2. Now let's project forward. Let's imagine if the next bar were to do this. If we anticipate that to be happening soon, we can do sideways time range comparison as if that was going to happen. And we see that in this scenario, T2 would be wider than T1. Also, if this bar was to show up as such, this would definitely be a retracement. That would be point C. In other words, this would be A going down to B, B would go up to C, and C would be going down to D. Now that only happens if and when we confirm this low here. Again, we're assuming that this bar may show up as such the next few days. What that would do is to tell us to focus in on this retracement here. How deep would that retracement be? Well, let's take a look. So there's our A, B, C in the making. Endpoint C would be less than a 50% retracement if the market was to do this. So now let's review. We have a somewhat shallow retracement at point C. And number 4, wider time range here if and when we break through to the downside versus here. And we also see this strong long down bar that breaks below this pivot low. So these are the 5 items that we have to consider when we think about possibly shorting on a breakout 1 tick below point B to the downside. We're asking if the next bar was to show up like this, do we want to get in to the downside and trade short? Well, let's go over these 5 points that we see over here. Number 1, a drop from a higher high. That's not really that good. Sideways comparison showing a narrower T2, which is right here, compared to T1. That's not too good either. Number 3, shallow retracement at point C. Now if we're going to break out below B, that's a good one. Wider time range in a series, that's also a very good one. Strong down bar, thrusting down, that's also a very good sign. Shows a lot of momentum. And here you see 2 no's and 3 yeses in terms of the breakout to the downside. So you can short below B, although this is no superstructure. I personally don't like item number 1. That to me is a little too risky. Now the reason why number 1 is not really that good is because you're dropping from a higher high, meaning if you had got in short over here, which means right about here, your stop loss needs to be 1 tick above C, and that could be quite a few dollars away from you. Now let's see how the next bar shows up. Well, it actually breaks through. Let me pull this chart back so we can see just what the next few bars look like. Well, actually the breakthrough is a good one. It breaks through here and there is follow through. Now remember, there are 2 reasons to not go short and there are 3 reasons to actually do go short. So I'm being conservative by saying that I may not trade this one. But if I were not thinking about going short, would there be good reason to buy somewhere down here? Well, let's do some calculations. Here I've drawn in the 100% measure move extension. Now why do I use the 100%? Obviously we have gone below the 78% measure move extension. So the 100% is next. Also look over here. We have a bar to bar, higher low, higher high relationship. What that tells you is that this downward move is slowing down just a bit. And when it does that, it seems like it is easing its way down to the next level, the 100% measure move extension level. We also see something very interesting here. The formation at C is a double top. you have two highs here, the second high being higher than the first, as mentioned earlier. And of course, here is that pivot low in between that confirms the double top. So now we can project down using the extreme double top projection off of this range here, from the low in between to the second high, and we can project down and see where the 2.618 calculation would come in. Here the 2.618 extreme extension off of the double top comes in very close to the 100% measure move extension. Let's see what the next few bars bring. Here the market turns back down. As it does that, it forms a time range. This time range can be compared to both this one and that one. Comparing to this one, it is equal, 3 bars versus 3 bars wide. And comparing to this one is obviously a lot narrower down here. So with time range comparison in a series getting narrower or neutral, it may be a good idea to buy around the average of those two numbers. But we need one more. We should have one more Fibonacci number in which to average. Here we see this low right here. We can use this range from this low up to point A and project down single-sided. And let's see what we get. Here you see the 1.27 single-sided extension and the 1.618. The 1.618 obviously is very close to the other two. So we can actually think about averaging these three calculations to buy this market for a little pop to the upside. Why? Again, let's review. Double top extension, second high higher than the first, leading to an extreme calculation. That's the supporting double top, supporting this ABCD measure move. This ABCD is the dominant measure move. We're using the 100% of the dominant measure move because we have a very good support in the extreme calculation of the double top. And the double top extreme calculation is reached here, not straight down, but with a little higher high, higher low bar to bar formation, forming this narrower time range before settling down to this area. And finally, there's this other single-sided extension right into the same neighborhood. So if we buy around here, let's see what happens following this. The market trades up. Down here, you have a very excellent buy. How much of an up move can we expect after we buy? I'm very conservative. I like to use a 38% retracement level as the place to take profits. And the main reason why is because we're coming off of a shallow point C retracement. We're picking a low here, but with very good reasons. And where should I put my stop loss? I like to risk about 1/3 of the minimum move. In other words, we look at how much the expected minimum move is, and we take 1/3 of that and we subtract that from our entry price. With that setup, we will have a 3-to-1 reward to risk ratio on the trade. So in the end, this actually is a superstructure buy right here where these three numbers average. Here I put up the September Dow Jones chart. Now I do this because somewhere around June is the transition period between the June contract and the September contract. So we need to just take a look at both contracts during transition period to make sure all the alignments are still there. Let's check. Time range here and here, still neutral, and against this time range, narrower, which is good. Dominant measure move A, B, C, D. Let's put in A down to B, up to C. So there's the 100% measure move extension of the dominant structure. Now let's take a look at that double top again and draw in the extension. And I'm going to drag from here up to there. And I'll keep an eye out on the 261.8 number. It lands right on top of the 100% measure move extension. Now let's take a look at this range here, and we'll drop that down 161% into that area. Here you can see all three numbers falling right around the same neighborhood. Average the three numbers and you should have a very, very good buying opportunity. And here, of course, is the superstructure set up also in the September contract. Whenever you have a superstructure set up, the accuracy is undeniable. And this market goes up at least 38% from here. Case study number 10, December Euro currency 60-minute chart. As you look at this last thrust going up, we see that it is a strong thrust. It is a move with a lot of long bars end to end. It has a very good chance of breaking above this high or even this high. Let's project forward and analyze the situation closer. So let's say the next bar does go up. That would bring this pivot low in play. In other words, we have to take a look at this retracement against this one. You can tell that it is very deep. And also, if and when this breaks above this high here, then this pivot low will come into focus, because that would be the making of this measured move. In other words, this measured move would come into focus as the dominant measured move with a very deep retracement, and then this would be the measured move within the measured move, also off of a very deep retracement. So we can think about shorting up here. We can think about selling up there. Here I've drawn in the measure move extensions for this dominant measure move. You can see that the 786 does not qualify as a measured move extension. So now we focus in on this one. We will look for this measure move extension, the supporting one, to support this area here. And for this, we will not use the 100%, but we want to focus in on perhaps the 127% of this move within the measure move. The reason why we're using the 127% measure move extension of this little supporting structure coming off of capital C is because with measured moves, it has the tendency to go beyond the 100% area. If we are focusing in on the 100% of the dominant measure move, we want the supporting structure to at least have some sort of overextension. And the 1.27 is the first overextension. So we will insist upon this supporting structure, this measure move within a measure move, starting from point C. We want this formation to at least have some sort of overbought scenario. And the slightly overbought scenario is a 1.27. And here, the 1.27 is the smallest measure move that we should use, because you have deep retracements, but you also have a very, very strong thrust to the upside. Because of this very strong thrust that you see to the upside here, you really want another Fibonacci ratio to work its way into that area. And here's where that second application of gaps come in. There's a gap right here. Here is the end of that gap. That end can be the beginning of a range. In other words, this can be the range that we can use to project up. And now we want to use the extreme calculation, which is the 2.618 single-sided extension, against that range which is part of the gap here. Why? Because we do want that extreme element in there somewhere. This little range here is acting as another support to go short in this area. And let me draw that in right now. Here I've drawn in the extreme 2.618 extension off of that range. I also left in the actual price movement up to that level. And you can see how strongly it rallies up. In fact, it goes through the average of these three numbers a little bit. But let's see what happens after that. Price falls big time. This goes to show how when you're coming off of deep retracements, this one is more than 78%, and so is this one, you can go against the trend because the trend is very weak coming off of these deep retracements, in spite of the fact that this move up is so strong. And thanks to this third calculation that we have here off of this little range, we have the extreme Fibonacci number that we want. Now let's compare time ranges. First, we see that this time range is wider the second time around over here. However, this one is about the same. We have to use this one here, this low here. So that one's about equal. The fact that this one is wider is not that big of an issue when this formation is there to support and break up this wider time range. This gap here really does a nice job. So time range comparison gets superseded by deep retracements and the extreme extension 2.618 off of that gap range. So up here at point D, you do have a superstructure cell setup. Okay, so how far should this thing move down, you might ask? Well, again, because of the very deep retracement at point C. And by the way, that point C is a little bit more than 78% deep. So you can expect a 61% drop from D. So here's a good place to get out of the market by covering your short position. Well, I hope you've enjoyed learning superstructure trading. Now you're on your way to profitable trading with this powerful new approach. With a little bit of practice, I know you'll master these steps in no time. If you have any comments or questions, don't hesitate to contact me. I love hearing from you. Thank you so much for watching, and good trading to you.